let's have a look at global financial management strategies. So why are global financial management strategies needed? Well, simply put, most businesses will now have some form of exposure to global business activities. It could be the fact that they are selling their outputs overseas, they might be buying inputs from overseas, they might be manufacturing their outputs or their products overseas, they might be outsourcing to overseas partners, or even though it's not up there on the slide at the moment, they could also be borrowing funds from overseas. No matter what the nature of these transactions, they're all going to increase risk, uncertainty, and complexity in a business's financial management. So what factors are actually going to create this risk and uncertainty? The first thing is that there are differences between countries. They have different currencies, different interest rates, different rules and regulations. And secondly, it's just that distance between the business and its overseas customers and suppliers that makes it more difficult to manage. So what risks are created as a result of these factors? Firstly, we've got the risk that exchange rates might change. We might have an appreciation or depreciation that changes the relative costs and revenues for the business. Secondly, we might have a change in interest rates, which are going to change the amount that we have to repay and the interest that we're incurring. Secondly, it could be to do with the potential non-payment from our overseas customers, or the situation that we've paid our overseas suppliers, but we haven't received the goods which we've paid for. So what are the role of global financial management strategies? It's all about reducing risk and uncertainty. We want to make sure the business is protected from adverse situations. We want to maximize the returns from overseas sales, and we want to reduce the costs associated with buying or borrowing from overseas. So what are our specific financial strategies that we're going to be looking at in future videos? The first one is about hedging through the use of derivatives, and that's all about limiting our exchange rate risk and the risk associated with changing interest rates. And secondly, we have to choose an appropriate method of payment to make sure that our customers are willing to buy from us, but also that we can receive the payment from them. And secondly, to make sure that we are protected in terms of when we pay our overseas suppliers, that we are actually going to be able to receive the goods and services for which we've paid.